Hi, and welcome back again to Tim Bigham's Big Time Options, Edges and Hedges. Taking a look today at selling extremes. And extremes certainly is the case here in Western Digital, one of the big kind of storage stocks, one of the AI related names, a little bit late to the party, but catching up lately in a big way, in a different way to short both implied volatility and the stock price, which are both at by far the highest levels ever seen on WDC. We always like to take that kind of fusion approach here at Big Time Options, combining fundamental, technical, and most importantly, implied volatility analysis. So let's jump in and take a look, shall we? First of all, here is the scan from Wednesday, right, that hit up WDC near the top of the list, certainly trading almost 2 times the normal volume, almost 72,000 contracts traded versus only about 40,000 average volume. More importantly, implied volatility at 100%. That means option prices have not been this high in the past 12 months on WDC. Fast forward to Thursday, right, and that piqued our interest. Fast forward to Thursday, here it is again, WDC making the list one more time now with almost 100,000 contracts trading versus average volume. Because of the volume on Wednesday, the average increased to 41,000, but well over 2 times the normal volume, right? And implied volatility went higher, right, by basically 4%, staying at the 100% level. So option prices have never been this high. We'll take a look just how high in a second. As we said, we like to use that fusion approach. So looking at the fundamentals, I simply pulled off. Here is price to sales. Here is Wednesday, right? When we first were kind of learning, you can see here's a 5-year WDC price to sales chart. Price to sales never even close to 5 times, right? Hovering right around that 2 to 3 times level. Then as we started to build here, you can see it going parabolic on Wednesday, getting to over 20 times price to sales, right? This is after the last earnings report, where we'll see in a second, certainly revenues and earnings beat, but the stock price reaction far exceeded the earnings and rev beat, to say the least. Thursday, we saw the price of sales had even higher because the stock was up on Thursday, right? Once again, but didn't close near the highs, which gave us the impetus for the trade. So closing almost at 22 times price to sales, the first time ever it got above 21 times price to sales. Here's a quick little note that I think kind of summarizes it briefly. It's a pseudo bullish note, but if you really take a deep dive, I think it's a little more bearish, right? Third quarter, this is last earnings report, showed 3.3 billion in revenue, a 45% year-over-year rise. So a year ago, last June, right, earnings, it increased by 45%. But the stock last June was at 60 bucks or so. Now it's over 700. So you've seen a 12 times increase in the stock price, right? That's why we're seeing this huge ramp up in price to sales on the company, right? So certainly a lift would have been expected. This kind of lift may be getting extreme, right? You can see earnings nearly doubled from last year, but as we said, the stock up 12 times, right? So far exceeding the earnings doubling over last year, right? Looking forward, they're certainly going to continue to probably be good, but they have to be even better than what they're expecting to justify these multiples. Here's a year-to-date price to earnings chart, right, to take a different look, right? You can see to start the year, PE was around 20 times price to earnings. Now we're at over 42 on Wednesday's close. We almost hit 45 today with the further rally. So you can see valuation multiples certainly getting to extremes here. It'd be hard to imagine the multiples continuing to expand, certainly at this pace. Might they go higher, right? But I think going this parabolic, tough to imagine them going at this parabolic rate over the foreseeable future. Another thing we always like to look at is the technical analysis. You can see the stock closed basically 6 days ago, right, at just under 550. Now we're close to 800. So this, well over 50% rally over the past 6 trading days, certainly getting extreme. I love that shooting star today, right? Traded up almost 800, reversed and closed under 750. Might be a sign finally that the buyers are getting fatigued and the sellers might be taking charge. You can see all the other technical metrics, right? Certainly overdone. Shares trading at a huge premium to the 20-day moving average, by far the biggest premium over the past 12 months. 9-day RSI back over 80, hitting again levels that have always signaled kind of a short-term top, right? MACD at by far the highest extreme we have seen over the past 12 months, right? Bollinger percent B well over 100. Another sign things are getting rich, no doubt about it. And implied volatility will take a different and deeper dive at it in a second here, at extremes as well. So certainly the technicals pointing to things perhaps getting a little bit overdone here, right? The price action we saw today, I really like that shooting star with the stock traded up towards 800, but reversed and closed back towards the lows of the day, right? So that is many times a sign of maybe a short-term top or at least consolidation, which is all we need. And speaking of that implied volatility, as we said, here I pulled off the implied volatility, and this is on the 120-day, the longest one on this particular chart, right? You can see I've hit by far the highest level over the past 12 months, no doubt about it. This huge rip higher. What does that mean? Option prices are the most expensive they have ever been, especially on the long end, right? We can see from Wednesday in red to Thursday in green that implied volatility jumped even further, right? The 120-day moving from 97 to over 100. Here's a quick little 20-day chart on a generalized IV. You can see 20, basically a month ago, right? IV was under 80, now approaching 100. So you see IV up 20 vol points or 25% in the past month. So we're seeing IV head higher, the stock head appreciably higher, even on the long end, right? Moving up here again, the IV shorter term and longer term elevated at 100%. I pulled off, this is the 360-day 60 delta chart. This is a 5-year view, right? You can see up until just recently, right, it was fairly well behaved, trading basically between 55 and 40-ish, right? So somewhere around the upper 40s on average. Then lo and behold, we saw this huge move higher here. Then we've seen even a bigger move higher over the past few days, right? A shorter term look at it. Here it is on a 6-month basis, right? That same 60 delta, 360-day IV now far exceeding the highest level seen. It's trading up towards well over 90, right? When previously, anything over 80 was certainly considered rich. So IV certainly getting very expensive as well. Stock valuations at the highest level we have ever seen, right? IV, the highest level we have ever seen. The stock, the most overbought level we have ever seen. That sets up ideally for a longer term sell, premium trade in a kind of, nuanced fashion, right? So the trade was simply going out as far as we can go, December of 2028. Like doing that because you got plenty of time for all the reversion either on price, IV to happen, right? And you have many shorter term options to continue to hedge if IV stays up there. If the stock heads higher, right, we can continue to sell shorter term put spreads, bring in more premium, right, get a even bigger cushion on the trade. So the trade, I actually did the trade today shortly after the opening when we saw the stock weakening, right? It had traded up, I said, towards 800. Stock was at 780-ish when we put the trade on. We like waiting for that weakness, right? So going out, selling the December of 2028, 980 call, and 800 put, getting $770 net credit on the trade. Here's the actual trade, as you can see here, and The trade is actually 52 deltas net short, right? Selling a 74, selling a negative 22 on the put, even though the 800 puts, right, are in the money by about 20 points at the time, right? The calls were about 200 points out of the money. The calls carry a 3 times greater delta than the puts because of the upward drift in stocks and, most importantly, the IV. We sold well over a 91 IV on the trade. So we're really looking for IV to come down or the stock to revert and come down here. Plus, we're positive theta time decay. We make 36 cents a day, right, on the trade. 22 theta on the calls. We're selling 14 theta on the puts. So we get paid to wait, right, by the theta. And theta is higher because IV is much higher. So with the stock, when we did the trade at 781.33, our upside break even, right, which is simply the 980 strike price plus the $770 credit we received, right, 1,750 is our upside break even on the trade, right, or 968 and 67 cents higher than where the stock was when we put the trade on. 123% upside cushion on the trade. That equates to about 37.5% annualized. So the stock, which has ripped higher here, would have to continue to go up 37.5% annually for the trade to even be considered to get in problem. Downside break even virtually zero, right? We're selling the 800 put and receiving 770 for it. So our downside break even is 30. We don't even really too much worry about that, right? That is kind of a non-event, and it allows us to be more aggressive with put sales shorter term, right? And since we're out to December of 2028, we have plenty of time to continue to sell put spreads if need be. But we're really just looking for either the stock to drop, right? Because we are net short deltas, as we said. We're, on the delta side, 52 deltas net short, and IV to drop as well from the highest levels we have seen. So we're simply looking for this last spike to maybe return here, right? We're not looking for it to collapse back anywhere near there, but simply a 5-point vol drop would certainly make sense. We'll take a look at that in a second. Here's the requirement for selling one of these straddles naked, about a $15,000 requirement. So if you're approved for naked option selling, that's what would be tied up in the account. Certainly that can expand, so you probably want to give yourself a little more wiggle room. I gave another $1,300 or so wiggle room, but even a little bit more certainly makes sense. So this is a way to go about selling a stock that is getting absolutely overbought on a technical basis, finally maybe showing a little bit of fatigue here at the most overbought levels we've ever seen. From a valuation standpoint, certainly the most overvalued we have ever seen this stock as well, right? Things getting out of control there. And then IV, again, the highest level of IV ever on the stock. So selling the highest IV level ever, selling the stock at the highest price, at the most overbought it's ever been, at the most overvalued it's ever been, I think makes some probabilistic sense. And I simply did a quick little look at what if we had kind of a reversion of 5 vol points, right? So here is the trades. Here is the call side, right? Here was with the vol where it's currently at 92.06. If we drop it 5 vol points, right, the calls pick up about $20 going from 366.42 to 346. So a simple 5-point vol drop, right, going from where it's at now down to here, that's all we really need, right, would provide a almost 20% or 20-point gain on the call side. And on the put side, same idea there. The puts would drop, moving if we go from the 90-ish to 85 on the put side, we pick up just under 20 points. So you're picking up almost 40 points or $4,000 just for the drop in IV, right? Also interesting to note that if IV does drop, right, the call delta becomes less, the put delta becomes a little bit more, right? So the trade becomes less short. So that huge jump in IV makes it more short, right, which is kind of where we want to be given the fact the stock is historically overvalued and historically overbought. So hopefully provide some insight how we go about identifying trade opportunities. In this case, a novel one at Delta Derivatives, but it was always like to say here, right? Trading is all about probability, not certainty, right? So make sure you position size accordingly. Make sure you continue to hedge, especially if the stock moves to the upside. The downside, I think you can live with a $30 downside break even, right? But to the upside, certainly hedging by selling some short-term puts makes a lot of sense. And somewhere along the way, we're either going to get the stock slowing down or the IV slowing down, which is all we need. Because remember, we're getting paid every day by that high 36 cents a day in theta. So sometimes you just got to say what the and go for it, right? And we all know this ends badly. So until next time, as always, here's to good trading. Take